Imagine you walk into a financial advisor's office, same city, same firm, same logo on the door, but you have $50,000 saved. The guy who walked in before you had $5 million on. You will not receive the same experience. You will not receive the same advice. You will not even speak to the same kind of person. And here's the part nobody tells you. The difference isn't just in the quality of service. It's in whose interests are actually being served. This is how the financial advisory industry really works, sorted by how much money you bring to the table. Let's start at the bottom, not because it's where most people stay, but because it's where most people begin, and because it reveals something important about how this entire system is designed. You have somewhere between $0 and $50,000. Maybe it's your first savings account. Maybe you just paid off your student debt and you're ready to do something smart with money for the first time. You go looking for a financial advisor. What you find is this: most of them don't want to talk to you, not because they're cruel, because the math doesn't work for them. A traditional financial advisor charges somewhere between 1% and 1.5% of assets under management per year. On $30,000, that's $300 to $450 annually. After overhead compliance costs and the time they spend on your account, they're losing money on you. So what actually happens? You get rerouted. You get handed to an app. You get pointed toward a robo-advisor, an algorithm that puts you in a portfolio of index funds based on a questionnaire you filled out in 4 minutes. Betterment, Wealthfront, Schwab Intelligent Portfolios. These aren't bad products, but they are automated. There is no human being thinking about your specific life, your specific job risk, your specific family situation. You're not a client at this level. You're a user. And the uncomfortable irony, the people with the least financial knowledge, the ones who arguably need the most guidance, are the ones least likely to get a real conversation with a qualified human. Move up. You're now in the $50,000 to $250,000 range. This is where a lot of working professionals live. Teacher, nurse, mid-level manager. You've been diligent. You've saved. You have a 401k that you haven't really looked at in 2 years. At this level, you can get a human advisor. Sort of. What you're most likely to encounter is someone at a large brokerage, a Fidelity, a Merrill Lynch, an Edward Jones, who works on commission. And here is where the conversation needs to slow down. There are 2 legal standards that govern financial advisors in the United States. The first is called the fiduciary standard. It means the advisor is legally required to act in your best interest. The second is called the suitability standard. It means the advisor only has to recommend products that are suitable for you, not the best option, just one that qualifies. A lot of the advisors you encounter at this wealth level operate under the suitability standard, which means they can legally recommend a mutual fund with a 1% expense ratio when a nearly identical fund exists with a 0.05% expense ratio, as long as both are technically suitable for your situation. That gap, 0.95%, sounds small. Over 30 years on a $150,000 portfolio, compounding at 7% annually, the difference in ending wealth is over $200,000. This isn't illegal, it's just the business model. And most people at this level don't know enough to ask which standard their advisor operates under, so they don't ask. Now you're in the $250,000 to $1 million range, the high-earning professional tier. You're a dentist, an engineer, a small business owner who had a good decade. Something shifts here. Advisors start calling you. The industry has a name for people in this bracket. Mass affluent. You become worth pursuing. The conversations get warmer. The office gets nicer. Someone offers you coffee that isn't from a machine. But here's what's also happening at this level that almost nobody talks about. Product complexity increases, and not always in your favor. You start getting pitched on things, annuities, whole life insurance policies with investment components, alternative investments, non-traded REITs, private funds with 5-year lockup periods. The fees on these products are often buried. A variable annuity might carry total annual costs of 2% to 3%, layered across mortality charges, fund expenses, and rider fees. The advisor selling it might receive a commission of 5% to 7% upfront. Now, some of these products have legitimate uses. There are real situations where a variable annuity or a whole life policy makes sense. The problem is that at this wealth level, you're being introduced to complexity at the exact same time your knowledge gap is still significant. And complexity in finance almost always benefits the seller more than the buyer. The advisors at this level are better trained. They are also better salespeople. $1 million to $5 million. Now, we're somewhere different. This is the threshold where a new category of advisor appears. The Registered Investment Advisor, or RIA. These are typically fee-only firms, meaning they charge a flat fee or a percentage of assets, and they don't earn commissions on products they recommend. By structure, their incentives are more aligned with yours. The conversations change. There's actual financial planning happening, not just investment management, but tax strategy, estate planning, insurance review, cash flow analysis. You have a named advisor who knows your situation. You might even get quarterly reviews. You're no longer a user. You're a client. The industry has a term for the invisible line between mass affluent and this tier. They call it emerging wealth. Crossing it means crossing into actual white glove territory, and the caliber of advice genuinely improves. But here's the quieter truth. Even at $2 million or $3 million, you are still, relative to the advisory firm's book of business, a smaller relationship. The partner who runs the firm is probably spending her best hours on the $10 million and $20 million clients. You get the associate. The associate is good, but the associate is not the partner. The attention is real. It's just rationed. $5 million to $15 million. This is where the architecture of wealth management begins to look genuinely different. Private banking opens up at J.P. Morgan Private Bank, at Goldman Sachs, at Morgan Stanley. The minimums typically start at around $5 million to $10 million in investable assets. What you're accessing isn't just better service, it's a fundamentally different toolkit. You get access to alternative investments that aren't available to retail investors. Private equity funds, hedge funds, co-investment opportunities alongside institutional money. You can get lending against your portfolio at favorable rates. Your estate planning is coordinated directly with your investment strategy in real time.